Athleisure brand Lululemon reported fourth quarter earnings, and it was a big-time beat. Earnings came in at $4.40 per share versus $4.26 expected. Revenue rose 30% year over year to $2.8 billion. And the company issued guidance of $9.4 billion in 2023 revenue. That's compared to Wall Street's estimates of $9.1 billion. Lululemon shares popped 14% on the news. So, Scott, this seems like a good entry point into a discussion of high-end retail more generally. On the whole, the sector's been doing really well. Nike recently reported 20% annual revenue growth. So did Hermès and LVMH. We saw record revenues at Williams-Sonoma and Ulta. This feels like a really big year for retail. But the headlines don't really seem to match. So, weren't consumers supposed to be cutting back on spending?
Yeah, has anyone heard from the recession? I mean, you're not seeing it in retail. You're not seeing it, especially retail. I think some people would argue that the top decile of income-earning households, which my guess is make up a disproportionate amount of Lululemon's business, are doing really well. I don't know if that's true of Nike. I think Nike, their consumers across the range of income levels. I know that I think 2/3 of Nike's business domestically is actually people under the age of 30, and that, 2/3 of the U.S. business is from people under the age of 30, but 2/3 of their total business is from consumers outside of the U.S. So Nike is a little bit of a global indicator. It's a global indicator on youth. And I guess that it seems like globally, the top quartile, if you will, globally, young people are still spending money on shoes. So it was a great quarter. But again, it's further evidence that for the last 18 months, we've been a month away from a recession, and it keeps getting pushed back. So, but we're not seeing evidence of this in specialty retail. Restoration Hardware did report, a fairly mediocre quarter, but that's more kind of unique to housing and what's going on there. People aren't moving because they're either trapped with a low mortgage rate or they don't want to buy a new house because of high mortgage rates. But specialty retail, it would be difficult to find evidence of a recession. Again, if you didn't know we're supposed to be going into a recession, would you know we're supposed to be going into a recession? So this is just more evidence of that. The consumers are still spending. So in Lululemon, it's just an incredibly well-run company. They have beat sales projections in 55 of its last 63 reporting periods. So that's just incredible. And year to date, their stock's up 13% after declining 20% in 2022. Nike's up 3%, the S&P's up 5%. And Lululemon, because of their reputation for consistently beating projections, trades at a 20 times EV to EBITDA multiple. And their historic multiple has been 32. So some people might even argue it's a buy right here. Nike isn't as discounted. It's trading at a 30 times enterprise value to EBITDA. It's considered one of the best brands in the world. But still, it trades at a higher EBITDA than Lululemon. And speaking of the swoosh, their Q1 revenue increased 19% year on year. And for a company this size, that's nothing short of remarkable. And back in June of 2022, after an earnings report, we said that Nike's fundamentals were really strong and that the factors weighing down the stock, specifically supply chain, currency headwinds, and a closed Chinese market, would subside. The other kind of quick stat we didn't talk about, and this just blows my mind, is that the market capitalization of Hermès is now 192 billion versus Nike at 187 billion. So Hermès, the scarf company, and it does more than that, but they're famous for their scarves, is now worth more than Nike. Hermès trades at 16 times sales, Nike at 4 times. And basically, this has been the world's best bet, has been a bet on income inequality globally. Hermès, their 5-year total return is up 287%. Basically, it's quadrupled in the last 5 years versus the CAC 40. It's just up 5%. It's just striking. And Hermès is such an incredible lesson in scarcity. And essentially, our species is drawn to whatever is scarce because the things that were scarce were the things that could keep us alive. Food, especially sugary or fatty food, or mating opportunities were scarce. So we are obsessed with food. We're obsessed with sex. And if any of us are ever in a position where our survival is threatened, we become quickly obsessed with survival. So scarcity is sort of the ultimate marketing strategy. And you can create it artificially. So if you want to buy a Birkin bag, you can go into a store and point at one, and they're going to tell you there's a 2-year waiting list, and kind of in a very pedantic way, kind of raise their nose and say, not everyone gets to own a Birkin bag. And there is no super crazy AI-driven semiconductor rare earth material that goes into a Birkin bag. They could make a lot of these, but they purposely constrict supply such that they create the illusion of scarcity, not unlike what U.S. elite universities do by sitting on these multi-billion-dollar endowments and not using them to expand their freshman seats, because they become essentially the Birkin bag of a modern society, where the ultimate luxury item for a Chinese parent or a Dutch parent is to send their kids to an elite American university. And as a result, we can charge kind of Hermès-like margins. But essentially what Hermès has is a supply chain that makes beautiful products. Let's give them that. They are definitely artisans, but has done such a good job of being super disciplined around managing supply well below demand that they effectively have a cash spigot. And that is, if they needed another $500 million in EBITDA to meet earnings this year, it'd be super easy. They would just say, ship another 40,000 Birkin bags and ties and scarves to our distribution, and they will get absorbed immediately. And that ability to manage any projection they make, because literally an apocalypse could come, and I'm not sure demand would fall below supply. And analysts go, they're just going to hit their numbers because they have this tap of cash they can turn on at any moment. And as a result, you have a company, a luxury company, trading at 4 times what Nike is trading at on EV to enterprise, on an enterprise value to EBITDA margin. But this is a lesson in scarcity and how to manage a brand.
Mm. Yeah, it kind of reminds me what you and Aswath say about Apple and Tim Cook, which is like, the thing that makes Apple so great isn't what they've done, it's what they haven't done. They could be releasing all of these products, all of these services, but they specifically choose not to, which is what inspires so much confidence in investors. And so from the perspective of Hermès, and maybe even Lululemon, which is sort of a tier 1 brand, I mean, it's not luxury necessarily, but it's high end. When a financial analyst is looking at these companies and they are modeling out that the value of this company, that we should be applying a higher value on that company's revenues versus another, is it that the brand is just really great to them and that makes them think that there are strong moats around that business? Or is it literally, do you think it's more of like a financial calculation of what you said, which is there's a lot of money here that they could make that they are choosing not to, and we need to factor that into our model?
The answer is yes. So the other kind of analog here is that the auto company that trades at the highest multiple on revenues is Ferrari, because demand far outstrips supply. Could they make more Ferraris? Yeah, they're owned by Fiat Chrysler that knows how to make a shit ton of cars. But instead they don't. They purposely choke supply. All Ferraris are sold out before they hit the showroom. And you have to buy a lot of Ferraris to guarantee access to a new model. And they purposely constrain supply. And so essentially what you have is total certainty around them hitting their numbers. And the wealthiest man in the world has built his wealth on scarcity. The wealthiest man in the world sells stuff that we don't need, but we want. And that's Bernard Arnault. And Hermès is cut from the same cloth, if you will.
Mm-hmm. And just pivoting back to Lululemon. So a couple of years ago, they acquired Mirror, which is this at-home fitness equipment company. You install it on a wall, and it's got some weights that you pull on, and it was sort of the Peloton, the tier 2 Peloton for a while. Mm-hmm. So they acquired that company for $500 million. They just said on this report that sales came in way lower than they expected, and they even said that they might stop producing Mirror hardware altogether. So it appears that this is another hyped up pandemic company that sort of got lost in this acquisition. Do you think this is the beginning of the end for at-home fitness, or is there a place for this sector?
Yeah, look, it didn't work. That's the bad news. The good news is it doesn't matter. I think they spent $500 million on it. This is a company with a much larger market cap. And to a certain extent, it reflects well on management. Management needs to take risks and do risky things. And you can't keep failing, but occasionally a foul ball means you're swinging hard. So It's a blip. It doesn't really matter. Connected fitness. There's one connected fitness company I would argue. It's Peloton. It's got unbelievable NPS. Mirror was sort of a Me Too product that never really, I think, inspired that much loyalty. Difficult to set up. Just sort of, I don't know, just a bad cousin off Broadway to Peloton. And even Peloton's having its troubles, right? The company I would invest in home fitness is a non-connected home fitness company called Rogue. They just make gym equipment and weights, and it's just got a great kind of testosterone-driven brand. I think that's the play there. But yeah, connected fitness.
What is I've never heard of Rogue. Why are you?
Rogue's a gym equipment.
Into that?
Rogue's a gym equipment company. It just has a great brand. They do a great job managing their brand. It's basically weights, dumbbells, fitness equipment, bench presses, kettlebells, things like that. They do a fantastic job, and they've built a brand in what is a fairly non-differentiated category. So they're able to get exceptional margins. That's a great company. That's a company. If I ran a private equity firm, I would try and buy. I think it's a fantastic brand. But anyways, connected fitness. There's Peloton, and it's barely holding on. It'll probably get acquired once the stock goes up a little bit. But yeah, Mirror. There's some other stuff. I forget the other one that's going out of business. There's another one. Tonal. Yeah. They just haven't worked. They just didn't get there. They weren't easy to set up. Not that much utility. People want to be back in the gym. Rest in peace. So speaking, by the way, of the recession, or has anyone heard from the recession? U.S. retail sales surpassed $7 trillion for the first time in 2022. That's up $500 billion from 2021. Consumer spending increased almost 2%, 1.8% to be exact, month over month in January. That's the largest increase since March of 2021. And the NASDAQ 100 has entered a bull market, rising 20% from its December low. And the S&P 500 is up 5% year to date. So we have a bull market, consumer spending up, U.S. retail sales up. I mean, again, has anyone heard from the recession? It does feel like inflation is still a bigger threat than the recession. And also a decent strategy around investing, or where you should go to work, that is investing your financial capital or your human capital, is to bet on the top 1%. All over the world, our governments have been weaponized by people with money, and they are able to implement a series of laws and policies that take wealth from the bottom 99% and crowd it into the top 1%. And also globalization, network effects, lend themselves to the incumbents and people who are exceptionally talented who now have access to a global market. So the result is the top 1%, anything that caters to the top 1%, I don't care if it's Ferrari or Four Seasons or Gulfstream, which is General Dynamics, or Hermès, is killing it. If you're managing a company in the luxury space and you're not doing well, the CEO should be fired. That means it's a management issue.
Isn't this sort of the worst scenario, though? That, I mean, those statistics you mentioned would suggest that actually the economy is doing great, consumers are fine, there are no problems. But if you look at the headlines and general media coverage, you get this sort of panicky fear that the economy is in decline and that consumers are in trouble. At least that's my read on the general vibe. If that is even partially true, isn't this sort of the worst of both worlds, where you have these luxury companies on a total tear and then the rest of the economy is just kind of stagnant? I mean, isn't that something that we should get worried about?
Well, there's two issues here. One is a societal issue and one is an economic issue or a shareholder issue. A decent shareholder strategy is to invest in the 1%. Why? Because our society is going down the fucking tubes. I mean, effectively, and I think this is your point, American democracies used to be optimizing for the lower 99%. Now they're being optimized for the top 1%. When I was your age, Ed, and I moved to New York, I went to pretty much any bar and would be packed, and it was a ton of fun, and you could meet people, and we were sort of all commingling. Slowly but surely, the top 1% sequestered themselves for a better vibe, a more manicured, higher-end party scene called the Soho House, and then Zero Bond. And in London, it's all now members clubs. The whole world is being optimized for the top 1%. Are you rich? Don't worry, your kids will get into Brown. Are you rich? Don't worry, you'll get the best healthcare in the world. but it comes at a cost to the lower 99. And that's probably a bit of an exaggeration. It's probably more like the world's being optimized for the top 10%. That is iOS. And anything below that is paying a price. And that's not to say rich people aren't a good thing. You need billionaires. You need wealth creation at the top. But when you have this kind of crowding where 80% of all income gains go to the top 1%, that means the rest of the 99 got to split the 20. And typically what happens is this type of income inequality self-corrects. That's the good news. The bad news is that the mechanisms of self-correction are usually one of three things: war, famine, or revolution. And we're getting to that point. When just 3 people have as much wealth as the bottom half of America, at some point the bottom half of America figures out a way to take their money away because it's the easiest way to double their income. And this has happened over and over and over in Central America. Some very wealthy families weaponize government, put in place a series of laws and regulations where they don't have to pay taxes and their wealth grows so extremely. But the bottom 99% see their wages go flat or down. And so what do? Eventually they show up, they elect a nationalist, and they show up, knock on the door of the 1% and say, get your shit and get out of here, we're going to kill you. And then they take the factory and they nationalize it, and the whole thing goes to shit. They realize nationalized industry usually doesn't work very well, and they privatize it, and they start the cycle over. We're about 7 innings into that. I mean, just look at just fly into LAX, and I immediately get in my Escalade and bomb to the Beverly Hills Hotel, and I live an amazing life. But God help me when I go to the Rose Cafe in Venice and have any sense of empathy for our citizens and see what looks like a festival where thousands of people are camping out, but it's not a festival. There's nothing festive about it. It's thousands of homeless people lining the streets of everywhere from the beach in Venice to Wilshire Boulevard, where I used to play basketball at Westwood Park. It's now a homeless encampment. So, income inequality, investing in the top 1% is a great investment strategy, but you're right. It indicates a real underlying sickness in Western democracies where we have decided to optimize for 2 cohorts, and this will get me in trouble. And New York is the head of that. New York is optimized for 2 people: rich guys and hot women in their 20s. And for everyone else, it's a soul-crushing experience. Welcome to America.
I mean, just coming back off of our last discussion, that we were sort of criticizing catastrophism. I mean,
am I the catastrophist?
Now you're the catastrophist. You said we're 7 innings in. At what point are you going to get are you going to get seriously worried about this? And let's just use like Hermès as a proxy. At what point is Hermès no longer a buy because the wealth will continue to accrue to the top 1% who will keep spending their money on Birkin bags? Like how far out do you think we are? How bad would it need to get in order to reach that point? Because my assumption is you don't think that this is happening tomorrow. You'd believe that this is just a signal that it could happen in the future and we need to be wary of it. So my question is, where are we in that cycle?
Well, you could argue, I said we were 7 innings into a 9-inning game. You could argue we're already in the 11th inning. We're in extra innings because I would argue that Donald Trump is evidence of this.
Yeah.
And that is the middle class goes sideways. They see via Instagram and via television and Succession and, from their friend whose kid went to work at Google and made millions of dollars, everywhere, how wealthy everyone else is being shoved in their face. And meanwhile, the majority of America hasn't had a raise in 40 years. And they get angry. And when people get angry, they become very vulnerable to nationalist, fascist type of content, which is essentially the same thing over and over. Your economic problems, your economic stress, your anxiety is not your fault. It's the fault of the elite. It's the fault of academics. It's the fault of the current administration. And I'm going to change things, and I'm going to demonize these immigrants who are taking your jobs and the cultural elite who talk a big game but then soak you for all your good. I'm basically this kind of nationalist, not discouraging violence against your enemies, claiming only I can fix it. I mean, history really does repeat itself here. The reason that Hitler came to power was for 2 things. 1, the Weimar Republic, exceptional inflation, and 2, the Great Depression. People don't want to say, oh, it's cyclical, it's part of the market. They want to think, oh, it's someone else's fault. And when someone convinces them it is someone else's fault, we go down a very dark path. And I would argue that an individual who inspired a insurrection vis-a-vis a social media app and was calling for his vice president to be hanged, and our representatives were hiding in the rafters from a mob, we're kind of already there. We're kind of already at the ninth inning.
Let's go to Mia on the street.
Do you own any luxury brand items?
I do.
Gucci, Yves Saint Laurent.
I have a pair of heels, but I don't wear them anywhere.
I used to have Yeezys before. I don't even know if you consider. I'm selling them now, so if anybody's interested.
Okay, so I have a YSL purse, but we go to Hawaii because Hawaii sells them for cheaper because they're competing with the Asian market.
Good tip.
Yeah, good tip.
Is there something that you have your eye on, like a especially luxurious product that you're hoping to purchase at some point in your life?
I've always wanted a Prada Clio bag.
I want to be able to buy a good watch at some point. A Ferrari, to be honest.
Say, would you spend like $30K on a purse, for instance?
Someday, yeah. If I love it, yeah. Why not?
Awesome. Yes, I see that in your future. And how do you feel about like a Birkin bag?
I love it. It's one of the dream.
I could not recognize one if I saw it.
I really hate purses, so I'm purse adverse.
If I were as rich as Drake, I'd probably be collecting them too.
Luxury product in general is a manifest symbol of class division that harms most of humanity.
It's also like false comfort to have things like that, and it's false luxury. It's not true luxury.
And what is true luxury then?
Love.
Sheesh. Yeah. Hell yeah. Rock on. That was sick.
I think that this is the economy where, people in our age group just struggle to afford houses. So maybe luxury items before that are not a great idea.
What does your luxury look like?
Being so rich, you could throw money off a yacht.
Why do you buy luxury purses? What do they mean to you?
Okay, so, it's about status, Yeah. So, like, you grow up seeing, like, all these, like, fancy things, and you're like, ooh, I want that, but it's all a meaningless void.
Ultimately, it's all a meaningless void?
Yes.
Okay. Would you spend $30,000 on a purse?
Of course not. That can go towards your education, folks.
So true. Facts.
You don't really need all these things, because I was listening to this other podcast about happiness, and it's not about, like all the things you collect. It's about experiences and all of that. But it's like you question, why do you even want these things? Like this Pauline bag. Why do I want this? I don't know.
All right.
Want to know what my name is?
Yeah.
Wealth.
Is it?
It is. You want to see my ID?
Wow.
It's wealth.
Damn, that's crazy.
Well, you chose the perfect person to talk about luxury.
Sure did. All right. Thank you, Will.